Hey guys, I'm back with another video for FAR 1. In this one, we're continuing our discussion of Chapter 10, Non-Monetary Exchange. Basically, what I'm going to do in this one is I'm going to go through a quick example of basically this formula that we just went through, that we walked through in excruciating detail. And what I'm going to do is that I'm going to show you multiple ways of solving the same problem, one using this formula, and then the other ways to sort of plug one of the accounts. All right, so let's look at the facts here. We have basically, we have these two corporations. We have Loot Lake Corporation, Tilted Towers Corporation. And then what these companies are doing is that they're trading two pieces of equipment. Maybe they're trucks, maybe they're, other equipment. It doesn't necessarily matter what they are, but they're trading these two pieces of equipment. And we have basically all the facts that we need are given to us. So basically we have the equipment at the cost. And we're given the cost. We have accumulated depreciation for both the equipments. We have fair value of the equipments, and then we have the cash that is given up. So that would be 0 for Tilted Towers. I didn't write it in, but it's 0. And then we're going to prepare journal entries from Loot Lake's perspective. That's the stuff written in red that I just underlined. So the first way that we could do this is that what I'm going to do is I'm going to do it with the plug method, and then we're going to check it by using the formula. All right. So basically, let's go ahead and do this. Okay, so the first thing that I like to do with these problems is that I like to fill in the things that are easiest first. Okay, so what are the things that are easiest? Some of the things that are easiest are like accumulated depreciation, right? So we see the accumulated depreciation is $20,000. That's very straightforward. We know we're going to debit it. We're taking it off the books. We know it's $20,000. It's just straight up given to us. The old equipment, that's very easy. It's $60,000. It's given to us. We know it's a credit because we're reducing the asset, right? Cash goes out the door at $5,000. We're told that, so that means we would have to credit cash. Okay, then we have to look at the gain and the disposal of the equipment in the new equipment. The next thing I'm going to do is solve for gain, and we're going to plug new equipment. So now the facts are very important where it says with commercial substance. I forgot to mention that, but it is written there. This one has with commercial substance is the one we're doing first. All right, and so if we think back to our rules on these different scenarios of when we recognize gain and loss and all that type of stuff, what's going to happen is that because of the fact that this has commercial substance, we're going to recognize all gains and losses, right? That's our rule. And so we need to figure out what the gain is, okay? And so basically we have to compare fair value to book value. Okay, fair value is given to us at $45,000. Book value would be $40,000 because we would take this $60,000 here, we would subtract out the accumulated depreciation, and we subtract the accumulated depreciation from the cost, we get $40,000. Gain is $5,000. Okay, so that means that the gain on disposal of equipment is $5,000. Again, make sure you're writing out full account titles. Please do not just write gain. You will lose points for that. And then the final thing is to plug equipment, right? So we have 60, 65, 70. 70 minus 20 is 50,000. So that means that our new equipment would be 50,000. Now let's just do it where we use the formula and just check our work, so that way we make sure we get the right answer. So let's try to get both of these on here at the same time, okay? And you can print this out and you can have a copy for yourself as well. All right, so net book value of the old property. What would that be, okay? Well, that would be 40,000, right? Because we're Loot Lake Corp. We have equipment at cost at 60 and then accumulated depreciation of 20, okay? So let's just write it here in the margin. We have $40,000 of net book value that we're starting out with, okay? Then in the facts, we see that there's a gain recognized. Is there gain recognized? Yes, there is. It's $5,000, okay? So we would add $5,000. Then we move to cash paid. Does Loot Lake Corp pay cash? Yes, they do. We can even see it. It's a credit. It's $5,000. So we add 5. Again, like I said, we're ignoring fair market value of other property given up and other property received. Then we look at these two. Is there a loss recognized? No. Is there cash received? No. So those are both 0. All right. And then if we add that up, 40 plus 5 equals 50,000. So we would see net book value of new property right there, 50,000. It works, right? And so now we've done it two ways where we've used the formula, and we've also done it where we have done sort of the plug approach in the journal entry. Okay, now let's move on to without commercial substance, and we'll do it both ways. The first part that we should fill out, again, is the easy ones. I think the easiest is accumulated depreciation, equipment, and cash are all pretty straightforward. These are literally the exact same facts. It's just that we don't have commercial substance in this case. All right. Now what we have to do is that we have to determine, so now we're in the scenario where we have cash is being paid and we lack commercial substance. Okay, so we can actually flip back and we could say, okay, cash paid lacks commercial substance. What are we going to do? Well, we're going to recognize all or none of the gain. All right, all or none of the gain. Sorry, I think I got cut off. So that means that we have to do our little test. All right, and I'm going to cover this a little bit more extensively in another video, but just for now, our test is basically this. We have to take the cash involved in the transaction, and then we have to divide that by the total fair market value of the transaction. This is my way of writing it up. The book has another way of doing it. It's on page 519. This is my preferred way. I think this just makes more sense. It's easier to understand. And so this is the way that I do it. Okay. So the cash involved, clearly $5,000. Very straightforward. Okay. No issues there. The total fair market value of the transaction. Well, what is that? Well, we have to think about it. Okay. Loot Lake Corp. Giving up something worth 45 and something worth 5. So from their perspective, it looks like it's 50. From Tilted Towers Corp, what are they giving up? They're giving up something worth 50, and they're giving up something worth 0. So it seems as though the fair market value of the transaction, the total fair market value is 50,000. Okay, and those equal, right? On both sides of the transaction, Loot Lake side, it's 45 plus 5, which is 50. On Tilted Tower side, it's 50, right? And those have to equal, right? If I was to say that I'm going to give you $1, if you give me anything other than $1, then you're doing something wrong, right? Because that does not make rational economic sense. And in this class, we assume that the companies are rational economic agents. Okay, and so that's what we do. We say cash involved in the transaction divided by the total fair market value of the transaction. That gives us 10%. We do not meet the 25% test. And so in this case, we're going to recognize no gain. None of the gain will be recognized. Okay, so we don't need the little line item there. And so now we can do the plug approach, and we would end up with 45,000 in equipment because 65 minus 20 would give us 45. Now, finally, we can check ourselves with this formula. I'm just gonna kind of leave it there and then just sort of copy it over here in the corner. Give me 1 second. All right. So the net book value of the old property, let's just get that showing. Again, that's 40,000. That hasn't changed. Did we recognize a gain? Well, we look at our journal entry. We most certainly did not. So that would be 0. Cash paid. We still pay 5,000 of cash. So that's the same. Again, there's no fair market value of other property. There's no loss. And then there's no cash received. So those are both zeros. And then we ignore the last one. So we end up with $45,000 as our new net book value, which equals the 45,000 we got there. Okay, so just again, 2 different ways of doing it. This is more of a formulaic approach. This is a plug approach. The reason I prefer to have both is because if you do this and you do this, you're more likely to catch an error. If you just do this way or you just do the other way, you might make a mistake and not catch it. And so that's why I would recommend doing both. I should be making one more video for this topic about like the different scenarios in a little bit more detail. And so look for that one as well. And good luck, guys.